Understanding the tax implications of investing abroad. When considering investing in a foreign country, it's essential to understand the tax implications of doing so. The U.S. has a complex tax system, and investing abroad can significantly impact your tax obligations. Here are some key points to consider. The U.S. has a citizenship-based taxation system, which means that U.S. citizens and residents are taxed on their worldwide income, regardless of where it's earned. The Foreign Account Tax Compliance Act, FATCA, requires foreign financial institutions to report certain financial transactions to the U.S. government. The U.S. has a double taxation treaty with many countries, which aims to prevent double taxation on income earned by U.S. citizens and residents. #The impact of foreign taxation on U.S. investors. The impact of foreign taxation on U.S. investors investing abroad can have a significant impact on your tax obligations in the U.S. Here are some key points to consider. Taxation on foreign-sourced income. If you invest in a foreign country, you may be subject to taxation on the income earned from those investments. Tax credits and deductions. You may be eligible for tax credits and deductions on your U.S. tax return, which can help reduce your tax liability. Reporting requirements. You may need to report your foreign investments on your U.S. tax return, which can be a complex process. FATCA requires foreign financial institutions to report information about U.S. account holders to the IRS. Financial accounts to the IRS, which can be a complex and time-consuming process. Understanding FATCA and its implications. FATCA, enacted in 2010, is a U.S. law that aims to combat tax evasion and money laundering by requiring foreign financial institutions, FFIs, to report certain information about U.S. account holders to the IRS. The law applies to U.S. citizens and residents, as well as certain non-resident aliens who have financial accounts in the U.S. Key features of FATCA reporting requirements. FFIs must report certain information about U.S. Why invest in U.S. domiciled assets? Investing in U.S. domiciled assets can provide U.S. expats with a range of benefits, including tax efficiency. U.S. domiciled assets are subject to U.S. tax laws, but they are also eligible for certain tax benefits, such as the Foreign Earned Income Exclusion and the Foreign Tax Credit. However, even this approach is not without its challenges. Challenges for Americans living in Europe. The restrictions imposed by MiFID II create a complex and challenging environment for Americans living in Europe. The rules governing the sale of U.S. domiciled investment funds are not only restrictive but also often unclear. This lack of clarity can lead to confusion and frustration among expats who are trying to navigate the complex financial landscape. Key challenges, plus unclear rules and regulations, plus limited access to U.S. domiciled investment funds, plus difficulty in finding suitable financial advisors. One of the biggest challenges for Americans living in Europe is finding a financial advisor who is familiar with the specific rules and regulations imposed by MiFID II. Many financial advisors in Europe are not aware of the restrictions on U.S. domiciled investment funds, which can make it difficult for expats to find someone who can provide guidance and support. Examples of suitable financial advisors, plus those who have experience working with international clients, plus those who are familiar with MiFID II regulations, plus those who offer a range of investment options, including individual stocks and funds, alternative investment options. While finding a suitable financial advisor can be challenging, there are alternative investment options that Americans living in Europe can consider. This can lead to a complex web of tax implications and potential penalties. Understanding the tax implications of foreign pensions. When a U.S. expat joins a foreign pension plan, they may be required to pay taxes on the contributions and earnings. However, the tax benefits of these foreign pensions may not be recognized in the U.S. The U.S. government considers foreign pensions to be taxable income, regardless of where the pension is earned. The tax implications of foreign pensions can vary depending on the type of pension plan and the individual's tax situation. Expats may be required to file additional tax forms, such as the Form 2555, to report their foreign pension income. Navigating the tax implications of foreign pensions. Navigating the tax implications of foreign pensions can be challenging, for U.S. exchange rates can significantly affect the value of your investments, and it's crucial to stay informed about the fluctuations in the market. Understanding exchange rates. Exchange rates are the prices at which one currency can be exchanged for another. The benefits of diversifying across currencies. Diversifying your investments across different currencies can provide several benefits, including reduced exposure to currency risk, increased potential for returns, improved portfolio resilience. Understanding currency risk. Currency risk refers to the potential loss of value of your investments due to fluctuations in exchange rates. When you invest in a currency, you're essentially betting on the value of that currency against other currencies. If the value of your currency declines, the value of your investment will also decline. The impact of currency volatility. Currency volatility can have a significant impact on your investments. A sudden and unexpected change in exchange rates can cause your investment to lose value quickly. Dollar dominance. For global investors, investing in the U.S. dollar-denominated assets can be a good option for expats and international investors. Why invest in U.S.? With the right guidance, you can successfully cross-border invest and reap the benefits of international diversification. Understanding the challenges of cross-border investing. Cross-border investing involves investing in assets or businesses located in a foreign country. This type of investment can be complex and challenging due to various factors such as regulatory differences, currency fluctuations, cultural and language barriers, distance and communication challenges, tax implications. These challenges can be daunting, especially for individual investors who are new to cross-border investing. However, with the right guidance and support, you can overcome these challenges and achieve your investment goals. Preparing for cross-border investing. Before embarking on a cross-border investment journey, it's essential to prepare yourself with the necessary knowledge and skills.